We're going to work some exercises from the textbook Phillips 7e regarding chapter 8 about the receivables. And so we'll start on page 376 of your textbook with exercise 8.1, E8.1. This one says Black Horse Productions used the aging of accounts receivable method to estimate that its allowance for doubtful accounts should be $19,750. The account had an adjusted credit balance of $10,000 at the time. It was to prepare the entries for each of the following. First, the appropriate bad debt adjustment was recorded, and later an accounts receivable for $1,000 was determined to be uncollectible and was written off. So we're going to do the write-off based on the aging of accounts receivable. If they were nice to us and they said the allowance for doubtful accounts should be $19,750, that was so kind of them, because it was telling us you need to look at the T account or the general ledger account and adjust it to $19.50 rather than making the bad debt expense be $19.50, right? So the bad debt expense, since there's already a $10,000 balance in there as a credit, you want the credit balance to be $19,750. So you need to add another credit of $9,750 to allowance for doubtfuls. And the partner entry for this adjustment is bad debt expense. There would never be any other random numbers, or I'm sorry, random account names in an adjustment for bad debt expense. It would always be the allowance account, because this is just another example of the adjustments that you do at the end of the period. It's an estimate. Remember we had accruals and deferrals and estimates, and we used depreciation as our example of the estimate then, but we're adding this allowance adjustment, and that is also an estimate that would be done at the end of the period. All right, so the next thing is they said write off a customer's $1,000 balance because it's bad. So rather than hitting bad debt expense again, we're going to debit the allowance account to write this account off. So we debit allowance, credit that customer's accounts receivable for however much is bad. Okay. All right, so then we're going to go to E8.3. This one, during the end of the year end, December 31, 2021, Kelly's Camera Shop had sales revenue of $170,000, of which $85,000 was on credit. And so that's going to be pertinent, $85,000 of credit sales. At the start of 2020, accounts receivable showed a $10,000 debit balance. Now that's important. And the allowance, the accounts receivable showed 10 debit. That's correct, isn't it? But the allowance for doubtful showed a $600 credit. So those are just normal balances. That's good. Collection of accounts receivable during 2021 amounted to $68,000. So they're telling us in the data from 2021 is on the 10th of December, a customer balance of $1,500 from a prior year was determined to be uncollectible, so it was written off. Then on December 31st, a decision was made to continue the accounting policy of basing estimated bad debt losses on 2% of credit sales. So now that credit sales number is really important, $85,000. We're going to need that because we're doing the income statement approach on this one. The 2% times the 85 is what the bad debt expense is going to be for this year. They just told us that. All right, so now they want us to give the required journal entries for the 2 events in December. So on December 10th, they had a customer account that they determined to be bad. So we're going to do it just like we did this one up here. We're going to debit the allowance account and we're going to credit that customer's accounts receivable. I missed the 1,500 somehow. There we go. And then on the 31st, we're going to write off the bad debt by estimating the bad debt expense. And in this case, since we're using the income statement approach, we're not going to worry about what's already in the ADA account. We're just going to take the credit sales and multiply them by 2%. So the bad debt expense takes a debit, the allowance takes a credit, and both of them for the tune of $85,000 times 2%, $1,700. Okay. So that was the first thing we had to do. Then the second requirement says show how the amounts related to accounts receivable and bad debt expense will be reported on the balance sheet and the income statement. Okay. So this is requirement 2. On the income statement, in the operating expenses, we would show the bad debt expense. And then on the balance sheet, in the current assets section, we would show the accounts receivable and the allowance related to it to come to a net realizable value of 24,700. I was it 274? But anyway, they're just showing you how they calculated the balances. The 800 was just a beginning 600 minus the $1,500 write-off that happened on December 10th, and then plus the $1,700 adjustment that we made when we wrote off the year-end estimate. Okay. The accounts receivable balance started out being 10,000, and they're just telling you that they took the information that was in here, the credit sales of 85,000 added to the 10, and then the collections of 68 reduced the balance of accounts receivable, and then the reduction of accounts receivable because of the write-off. This write-off right here. The December 31st adjustment. Okay. Number 3, on the basis of data available, does the 2% rate appear to be reasonable? Well, see, the 2% rate does seem to be reasonable because the allowance account had $600 credit before this year's transaction, and at the end it has an $800 credit. So it's pretty close to the same. If it was going into a debit balance, would be where you'd really get the idea it was wrong. Also, I would mention that these 2 calculations they did for accounts receivable and allowance for doubtfuls, where they told you how they arose, how these 25.5 arose and this 800 arose, that was not a very effective way to show you. They could have just made a T account for accounts receivable and a T account for the ADA account and posted each transaction that had happened. It would be a lot clearer what had happened. Okay. I was going to reveal the answer, the official answer they gave for this requirement 3 about whether the 2% was adequate. They're saying it's too low because the allowance account had only 600 at the beginning and only 800. Oh, I see. They say it's too low because the write-off this year exceeded the beginning balance, but it still turned out that it was in the positive. So it's not terribly bad wrong, but you could consider increasing it from 2% to a higher number. Okay, then E84. Let's see what this one does. Prior to recording the following, Elite Electronics had a credit balance of $2,000 in its ADA. Prepared journal entries for each of the transactions. On July 31st, a customer balance of $300 from a prior year was determined to be uncollectible. Every time they tell you one's uncollectible, it's going to say a bunch of blah, 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 number, blah, 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 blah. And it's just always about debiting the allowance account and crediting that customer's accounts receivable. If they say account's bad, you always are going to use the allowance account as the debit instead of the bad debt. Okay. And then on December 15th, the customer balance of $300 written off on the 31st was collected in full. So if I've already written it off, can I just record the collection? Debit cash, credit accounts receivable? No, because there's not accounts receivable to offset. I have to reverse my write-off and reestablish that accounts receivable. And then I can show a normal collection of debit cash, credit, accounts receivable. So first I had to do the reversal to reinstate that accounts receivable. Then I have to show the collection. Okay. All right. One more on this chapter, which is E811. Going down a few pages. This is on page 378. All right. The following transactions took place for Parker's Grocery. On January 1st, they loaned $50,000 to cashiers of the company and received back 1 year, 8% note. This is about the notes receivable. All they're asking us to do to make journal entries for these transactions. Okay, so the first thing that happened is we loaned $50,000 to the cashiers of the company and received a note in exchange. So this is just a note receivable credit cash because we gave them money. Then accrued interest on the notes on June 30th. On January 1st, we issued this note, and it's an 8% note. And then June 30th, we're going to do a financial statement. So we had to true up our balances. So we have to calculate interest at that point. We take the $50,000 and multiply it times 8% because that's a full year's interest. Then we prorate it for the number of months that we're trying to accrue right now. So if $50,000 times 8%, what is that? $4,000? Yeah. So we're $4,000 would be interest for a whole year, but this is only 6 months. So half a year's interest is $2,000. 6 months worth of interest is what you could think of it. You don't just look at January and June. You look to see, is the whole month of January, is the whole month of February, is the whole month of March, April, May, June, 6 months. But if it had said January 31st, then you would have had to say it was a 5-month period, right? Okay, so then C, on December 31st, we received interest on the notes. No interest had been recorded since June. So we're going to get the whole $4,000 of interest because it's $50,000 times 8%. The interest is coming due, but instead of recording it all as interest revenue, we have to show we got the $4,000 debit and we credit the interest receivable that we already had recorded, and we credit the other $2,000 to interest revenue. Because that way, between the two entries on June and December, we recorded the whole $4,000 as interest revenue. But some of it had to be accrued in order to do a financial statement on the June 30th. Then the last one of these, and the last one for this chapter, December 31st, we received the principal on the note. So on December 31st, we got the $50,000 back. So we record that with a debit to cash and a credit to notes receivable to clear it off our books. And we're all good. And we say, thank you to these employees that paid it back, right? Okay, so that's all for this chapter.